Hi, I'm Jennifer Goodman, Realtor here in Austin, Texas, and I am with Sean Andrew of Vista Lending. And welcome back to Mortgage Minutes. Sean, it's been a while.
It has been. It's been a minute.
It's been a minute. Yes, the real estate year started out a little crazy, and your year in mortgage lending started out, well, heck, busier than ever, right?
That is correct. It's been really busy. A lot of refinancing still this year, even after last year with rates so low. But we're starting to see refinances stop. That happens through every boom. Those that do it, those that are savvy enough to be proactive have done it. There's still millions of homeowners that could refinance, but they need to be contacted because a lot of times they just don't know. They don't pay attention to rates and things like that.
Yeah, a lot of money to be saved. If you haven't looked at your mortgage rates in a while, now may be the time.
Absolutely, absolutely.
So let's start off with the market update overall, because the last time we did mortgage minutes was a few months ago. Just based on volume, we couldn't do it. So let's talk first, Sean, about the market update. What can you tell us? What's happening with Freddie and Fannie and rates overall? Because we're at a record low, it seems.
Yeah, we're getting close to it. So we hit kind of record all-time lows last summer in 2020. 30-year fixed pushed down to 2.5 to 2.75. Bounced around there for several months. 15-year fixed in the low twos, 2.25. And then we saw them edge up into the fall. Over the winter, about a quarter point to 0.3% higher, again bouncing around. And then over the last month, we have seen rates drop again. That is kind of twofold in the sense of stock market correction. After going up, it inevitably is going to come down and correct. Obviously, Delta variant is also at play in the global economic picture, and investors have a lot of fear of that. So that has also affected the stocks. And when we see stocks go down, rates tend to follow. So as of this minute today, I have locked a couple folks in at 2.75 to 2.8%. So we're kind of back down to that all-time kind of low market.
Wow, that is amazing. And just if I was thinking about a refi right now, and what's a perfect candidate look like who's, getting, and this might be a loaded question, but if you're getting that type of rate,
yeah, so the perfect candidate, everybody's different.
Okay.
Meaning, you have to be able to drop enough for it to make sense. The way we view a refinance is how much of the closing costs, that's your investment in that transaction, and what's your return on the investment. So if the closing costs are $4,000 and you save $300 a month, that's annual savings of $3,600. So we know in about a year, 0.2, you've recouped your closing cost. If this is a home you're going to live in 3, 5, 7, 10 years down the road, at least your plan, we never know what'll happen, then the argument can be made that it makes sense. A lot of it also depends on loan amount. If you're only dropping 1%, well, if you have a $500,000 loan, that makes a much bigger impact than someone that, say, has a $100,000 loan. So, refinance is case by case. I approach it as opposed to some lenders where it's, yeah, rate's 2.7 refi. Well, does it make sense? I mean, it's got to be win-win, not just for me to get a loan. And it's got to be based on your plan. Then there's other folks that may not be dropping much in interest, but are lowering their term. So do have a lower loan balance. Maybe we're only dropping them 1%, but they're going from a 30-year fix to a 15 or a 20-year, where the analysis on that is a much longer view, where we're saving $50,000, $70,000 over the life of the loan. Again, that person's someone who's going to occupy the home, or if they do move, maybe retain it as an investment property, where someone else pays their mortgage for the rest of their life. So everybody's a little bit different. There's no magic. How much do you drop your rate? I hear that from clients all the time. I heard you have to drop 2% for it to make sense. Well, maybe, but not necessarily.
Yeah, I really like the way you drew that distinction about the short gain to get you even. That's step one. And then step two is like, what's your longer term plan? And how can that play out to have you pay your note down more quickly? Like, wouldn't it be nice to not have that big house payment, or be able to take that same amount of money that you have coming in every month and all of a sudden start financing an investment property that cash flows. So I'm with you. Thank you for that distinction.
Yeah, yeah. And I'd say the last thing is to talk about maybe the real estate market more generally, which you're as in tune to as I am for sure. But, you know, it was extremely challenging for buyers over the last 18 months. I considered myself a pre-approval writer for about a year. I didn't do any loans. I just wrote lots of pre-approval letters while buyers were trying to duke it out for, you know, that price and competing with the seller to get their offer accepted. And we've seen a shift in probably the last 2 months. Values in Austin are not increasing like they were. I'm a firm believer they're not going to decrease, but a 7% month over month increase has stopped. And I'm seeing purchase contracts come in at a pace I haven't seen for about the last 4 to 6 months. Again, there's lots of buyers, lots of people getting pre-approved, lots of people interested. But when you have one house with 18 potential offers, only one's going to win. So we are seeing buyers come back into the market. We're seeing a softening in price, meaning a stabilization of value increase. And I think it's a little bit optimistic now, where I do believe we're still in the seller's market based on inventory, but buyers are going to have more opportunities.
Absolutely. And we are, from a real estate standpoint, I mean, we are back in our regular seasonality. People are away, kids are out of school, and this is a window for everybody to have a little bit more freedom than maybe they've had in the past. So people are taking off. People are doing all sorts of things that maybe have their attention away from home purchasing right now. And that is true of any sort of July, August timeframe as we move through. And, you know, kids go back to school around August 17th. And, you know, fall will come. And then to your point, we will probably see, as per usual, more homes come onto the market and buyers have more opportunities. And that pre-approval will continue to remain, even, you know, pre-pandemic, it was important now more than ever. While we're talking about the market update, maybe we can kind of veer off for a second and talk about what a pre-approval really means. I know you and I have talked about this, but some people who are watching may not understand what that means when they're going to buy their house. So real quick, do you want to share us a little bit about what a pre-approval is in your mind? Because not all pre-approvals are created equal.
True, true. So from a definition standpoint, again, I think you could talk lender to lender across the country and there may be different definitions, but my definition, and that's what I'm going to go by, a pre-qualification is a verbal discussion between me and a buyer. Here's how much I make, here's how much my monthly debts are, here's my credit score because I've got Credit Karma or Mint and this is what they say it is. And then kind of based on those variables, I can tell them how much they might qualify. So it's kind of a very loose thing. I mean, it's grounded, but we haven't really viewed documentation. We haven't run credit, et cetera. But that's where most folks start, just to get an idea. What would I qualify for? A pre-approval, which is also called a conditional qualification, but pre-approval.
Conditional loan, is that what you said? Sorry.
Conditional qualification.
Conditional qualification.
So when you get the letters, it's called a conditional qualification letter, but it is a pre-approval. And then what we've done in that sense is kind of gone past that first step. Now they've completed an application. We know their income, we know their assets, we've run credit, and we've run that through that loan through an automated underwriting system that has generated an approval, which is basically Fannie Mae or Freddie Mac's algorithm saying, hey, client and Sean, as long as everything you put into my system is correct, you are approved. Here's what I want: pay stubs, bank statements, driver's license, etc. And that's what we want for a buyer before we go make an offer on a property. It allows me to provide a more firm approval letter telling the seller, I have viewed income, I have viewed assets, I have viewed credit, every my purview, and I've run them through the system and they're approved. The next step, which some people do call a pre-approval, I do not. It's a formal approval, but I will actually run a client through underwriting without a property under contract. Most lenders won't because it's a strain on resources. I have to pay my underwriter to underwrite a file, and if I don't know if there's an actual transaction happening, I don't want to waste that time. That's what another lender might say. We're fine with that. So I will do a actual approval without a property, where we get a formal underwrite. Everything's been signed off. All we need is a property under contract and an appraisal. And in Austin, it's been advantageous to do that because in a normal market, not the last year, and I'll explain why, but in a normal market, it allows us to submit an offer to the seller saying, we don't need a financing contingency. I'm already approved. All we're waiting on is for an appraisal, and we could possibly close in a shorter time frame than the standard 30-day contract. In this market, that's not quite there just yet. The main challenge is appraisers. We have a limited amount of appraisers in every market. They don't grow on trees. They have to get educated and licensed. So it's not like a bunch of appraisers hit the market over the last year because of demand. And so appraisers are taking up to 3 weeks to actually turn around the transaction. But I still believe it makes the seller feel better. There's no financing contingency necessary, and they've already been vetted. All we need is the appraisal to come in and we're good to go.
Awesome. Well, thank you for doing that. And I know, I mean, we were just at the closing table yesterday. So having a pre-approval in this climate is essential. As a listing agent or as a buying agent, you know, we're not even looking at offers that don't have pre-approvals from realtors who bring clients to our listings. And when I go work with my buyers, there's no way I'm going to go make an offer if we don't know that they can buy it. The last thing any of us want to do as realtors is show a property and then find out our clients really cannot purchase that. So the fact that you take them through those steps down the road to get them to that point where all we're doing is waiting on the property is greatly appreciated. So like all realtors aren't created equal, all pre-approvals are not created equal. So thank you for taking us through that and how that affects today's market, because it is real.
Okay.
Awesome. So the last time we connected, and there's been a lot in the news lately, we talked about forbearance, mortgage forbearance. And for those who aren't caught up in what's happening in the world and latest announcements from the administration, can you share us a little bit about what you're hearing in the mortgage world about forbearance?
Yeah, so it's winding down, and primarily that is because there's so few loans in forbearance. So forbearance was the process as a borrower or a mortgage loan payer, customer, could call my mortgage servicer. The government mandated it during the pandemic that I could stop making my payments. It wouldn't negatively impact my credit. Basically, the amount that I wasn't paying would get tacked on to the balance of my mortgage. So inevitably, I would have to catch up, or when I sell the home, it would be part of the payoff. And at the high point during the pandemic, due to just a lot of uncertainty, job loss, et cetera, there was about a 7% of Fannie Mae and Freddie Mac's portfolio were in forbearance. They're down to right about 3% right now.
Okay.
And the majority of forbearance, folks that took forbearance, and I think it was like 50-50, were actually still making payments. They were doing it as an insurance policy. What if I lose my job? I want to have this opportunity, because what if it disappears? So let me get in forbearance now. I continue making my payments. But if I need to and something crazy happens, I have that ability to not. So we knew it would be a temporary thing. They have not announced a drop dead date. And with the Delta variant now seemingly ripping its way through parts of our country, who knows, there may be a pause on actually ending forbearance. But it's such a minimal part of the overall mortgage portfolio that we just don't really talk about it a whole lot as lenders.
Yeah, so in the state of Texas, do you see it state by state? Like, how are we in Texas? Is that 3% in Texas that you're referring to, or as a nation?
Yeah, I don't have specific. That was kind of across the US. Yeah. My gut tells me, as strong as Texas is employment-wise, probably less. But you could go into more rural areas and see where maybe more folks have taken opportunity of that, depending on their job stability, et cetera. but yeah, I don't have a window into the actual metrics of Texas.
Okay, so that leads us to our third and final point that we like to talk to in mortgage minutes, at least historically, which is pre-foreclosure. So with things as strong as they are in our economy, in Austin, seeing all of the people that are coming in, is pre-foreclosure a thing in
No.
Austin?
No. I think the last time I looked at foreclosures, there were like 2 in Austin. And, you know, I mean, they were completely trashed homes that probably were rentals and, you know, just needed a ton of work. So it's certainly a cash investor kind of transaction.
Mhm.
No, you know, people go into foreclosure because they don't have equity. You know, I bought a year ago with 3% down. My values stayed the same or gone down. I don't even have enough to pay a realtor to list it. I don't have the closing costs as the seller. So I'm just going to let this sucker go. And if it ruins my credit for the next 7 years, so be it. That's just not Austin Metro at all. I mean, you know, even if we look at the snapshot of the first quarter of this year, I mean, we were seeing 6 to 8% month over month appreciation. So you literally could have bought in December and your home could have been worth 15% more in March. There's just no reason to go into foreclosure. You actually probably have a decent equity position. You can sell and actually walk away with that money instead of destroying your credit and walking away with nothing.
Yeah, agreed. And when we look at Texas overall, housing prices went up 19% year over year when we look at June 2021 versus June 2020. And when we look at Austin, Austin is leading the pack. If we look at housing prices last year versus this year, we're up 42% overall,
Right.
which is massive. In terms of like the bigger markets in Texas, Austin has led the pack in terms of seeing home appreciation. So to bring it back to that discussion of pre-foreclosures, this is why when I talk with my investors, we're looking at outerlying areas outside of Austin, because cash flowing in Austin between our taxes and all those other things for investors just doesn't really flow. And I've been talking to Canadians and all sorts of people who are hearing things, and I'm like, yeah, we can't do that in Austin, but let me connect you with some people that we can. And so we're looking at those outskirts and opportunities, because our economics are just so solid. So that's a good thing. So if you are a home seller, we're a solid market. And if you are looking at holding onto your house right now and haven't looked at your rates in a while, maybe reach out to Sean and connect, because you may be leaving money on the table right now that could be better spent doing other things, having more fun now that people are out and about again, investing in something like another property or a trip to Disney. It doesn't matter. The point is, it's your money. Let's see how we can put it to the best use possible so you can lead your best life. So thanks for tuning in to Mortgage Minutes. Sean, thanks for our update. And we greatly appreciate your time today.
Take care.
All right. Thank you.